How do you know that you should walk away from a property even though you've invested time and money in the acquisition already? Hi, I'm Jaryd Krause.
And I'm Sam Powell, and we're the hosts of Property Pals Australia podcast. And in this episode, we're discussing commercial property number one that Jaryd decided to walk away from and why, as well as what it cost through that process. We also discussed his commercial property number two that he missed out on, but it was some really good advice and it was a good learning process for him. We discussed why it was a good one and why he didn't proceed with the high offer that ended up coming through.
Yeah, we also talk about the importance of in-depth due diligence checks on each commercial property deal, and we talk about some of the checks that were done throughout some of these two deals. We also talk about the strength in walking away at times to not make the shoe fit, and also how to not get attached to any property investment whilst you're in the search phase, even before the acquisition has been finalised. And lastly, Sam mentions and talks about projections of the current interest rate, where it's at, where it could possibly go based on Australia and the macroeconomy combined.
Yeah, there's a lot in this episode, so I hope you get a lot out of it. But as usual, before we get stuck into the episode, I just want to let you know that this podcast is not the only way that we can help you for free. We have this really great course called How to Maximize Your Borrowing Capacity on our website. So head on over to propertypals.au/resources to find that one. And it's going to help you obviously increase your purchasing capacity to help you purchase a higher quality property and increase your return on investment over time. So enjoy the episode and see you on the inside.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. So it's 69, and so 69 episodes under the belt. It's good. It's really good.
If you're listening to it and you want to watch it, Jaryd's looking very, I don't know, you're a single attractive man in the dark at the moment.
It's very dark. I'm halfway through moving, and I left one of my lights at my other place, and it's pretty gloomy outside. We've had some rain the last few days, which has been pretty good for the waves, but yes, don't judge me on my darkness at the moment.
You need to work on that tan. No. Anyway, we jumped on as we usually do, and Jaryd's still in the commercial property searching phase. He's had a few. I'd say it's pretty standard, I would say, which is a bit of a roller coaster of emotions in buying property. But yeah, you talk me through how you're feeling, my friend.
I'm feeling it's going slower than. And this is my fault for setting an expectation. Also, the buyer's agent did mention, roughly, how long it would take. It's been a little bit longer, but at the same time, you don't want to just rush into something, which I could have done 2 times. So I think it's worth talking about these two different deals that we've had in the last month or so, or 2 months, and yeah, how I'm feeling about it and what I've learned from it. So I guess the first one was, there was a retail shop in Sunshine Coast that I put a bid in. It had been actually up on, wasn't an off-market deal. It was on, I saw it was up on the internet. And where to start with it? What sort of data do you want?
Well, let's talk about the actual property. So I really liked it in the really strong location. It was in Noosa, I think it was.
Yeah, Tawantin. Yeah.
Retail is obviously a little bit different with the Retail Shop Leases Act. So getting your head around how that kind of works was good, I think, for you to do a little bit of more research, because I find that, you talk to people, clients, about their expectations of what this property is, the journey they're about to go on. It's just a dump of information, and people they like the brain can't absorb it all. But when you get into the thick of it, that learning process clicks in, and you learn so much faster when it's like in front of you, right?
Yeah, absolutely. You can't not learn because it's shoved in your face because it's moving quite fast. So it's funny. I heard from one broker that commercial is like it's real slow until it's not, and then it's real fast. And so I just got all this information shoved in front of my face, and it's like, all right, cool. As soon as you find the deal, let's get the finance broker ready. Let's get everybody in the team ready. Solicitors, get ready for due diligence, all that sort of stuff. So we did that. Got my mortgage. Got the yes from my mortgage broker, and then we went and started due diligence on it. And
so just to sort of stage it in. At this stage, you'd had offer and acceptance, and then you go into that due diligence phase. Yeah.
Yeah, I signed like the contract basically. Yeah, and so signed that, and then we went into due diligence and got the solicitor, and it was subject to due diligence finance, of course, as always. And when we started I had already got the solicitor had to go through and check, a bunch of different things and reports and the status and titles and all that sort of stuff for the property. And I had to take out title insurance. And I paid for title insurance, the solicitor, and obviously through the buyer's agent, they do the due diligence as well.
Can you break down the fees so people can understand? Because commercial
I think the solicitor was around. It was going to be around $3,000 to $4,000, and title insurance was going to be around the $1,200. And I didn't. I wanted to stage this. I wanted to stage the amount of work the solicitor was doing in case it fell through during due diligence. And so I paid for title insurance, and then I also paid for like just a few things that the solicitor needed to do in order to get the next stage of due diligence ready. I forget exactly what they were. And we started through due diligence. The retail shop was a small shop in a row of 6, and it was a gift shop and tobacconist shop.
Yeah, sorry, can I just inject a little bit? A lot of people I don't feel would know what title insurance is. Did you know what title insurance was when you
were? Not really.
Yeah, and what's your sort of understanding of it?
So strata. So there's a difference between strata insurance and title insurance, right? So strata insurance is basically, from what I have been taught, is the body corp. And then title insurance is, I don't know, would you be able to tell me? I'm pretty sure it's me, owning the title of the property, insurance against that.
Yeah, it's an insurance that covers you for a couple of things, but a lot of it's like that unknown when you're buying that title. So things like if there's unapproved building works on the property, then you don't know that. So the insurance can kind of cover you for, well, your expectation was that it was approved.
That's right.
So it's sort of like de-risking there, and then a big part of it is like outstanding rates, land tax, things like that. That could be the previous owner. And they're not disclosing that to you, so you could inherit that property, and then because when you become that owner, it's like, oh well, in the eyes of the government who's charging those fees, they sit there and go, well, this money's owing on this property, and you now own this property. Your conveyancing solicitors team should have picked that up, and it's just that sort of level of extra protection to go through. It's a pain in the ass. It's insurance, but
it is. But I mean, it's pretty important, and that's why I needed to get title insurance straight away, right? So, in case any of that did pop up, I was liable for anything, or in case I needed to do or change something with the property.
Yeah, because there's always that case. There's like the argument where, like, who owns the property? Like, you've got offer and acceptance. they they say, well, contract's dated, this date, so we don't have ownership over that property. It's like, well, no, it hasn't settled. There's that grey area of awkwardness essentially, and if something were to happen to that property during that due diligence phase up to settlement, then you just don't really want to get involved in that, because even if you didn't do anything wrong, you'd still have to, and someone puts it back on you, you still got to fight that, right? And that costs fees with lawyers, so it's just a safeguard, really.
Yeah, exactly. And so, any other questions you want to dig into before I continue around the
well, it was just pros and cons of this whole journey, right? And this is what I think it's great for people to understand your experience, because people can go back and reflect on this, because commercial is great. There are costs involved, and we don't land every single deal. And it can be a bit of a hit to the back pocket when you don't land deals, but it's just one of those things. It's just you'd rather, not proceed with an asset that is hasn't passed all those levels of due diligence, essentially. But yeah, I think that's pretty much what I want to cover. But let's stage it as to well, what are the pros and the cons of the deal? What did you like about it, and then what didn't you like about it, and why didn't you move forward with it?
Yeah, good questions. Before I answer those, there's something to add in terms of the costs. I had to get title insurance, which was $1,200 or something, and then I had to get some stuff done with solicitor, and I also needed to book in a building and pest check. What I walked away with, they ended up losing about $2,000, maybe a little bit more, from title insurance portion of the work that was done with solicitor. And what I did is I had booked in the building and pest check for a week from when I decided to end the contract or leave the contract. And I asked the building and pest inspector, or the building and pest company that I paid for, I said, can I just pause this or cancel this? I'm not going forward to the property and get a refund. And they said, yeah, we'll give you a credit if you go away and use it for your next one. So that's how I saved a little bit of money there. But yeah, there are costs involved, and it was worth losing those costs because of what happened throughout the deal. What I liked about the deal is that it was just in a really strong location, and the numbers worked. It was going to be, slightly positively geared for me, and it was at the price range where I could put most of the capital I had into a deposit, and it was a bit of a larger purchase at what I'm kind of looking at now. So I could acquire more property with more debt at that time, and yeah, it would have had a better growth rate. It would have had a pretty good growth rate. What I didn't specifically like about it, and I went forwards with this one because I hadn't had something come to me that was worthy looking into for a while. It was retail though, and I wasn't super stoked about just getting into retail. And then what I wasn't so sure on was that it was a gift shop and a tobacconist shop, and it was in the block it was in was really good.
The asset.
I was curious about how a tobacconist shop would go, and a gift shop. I haven't seen a lot of foot traffic go in those in these popular areas before. And so as we continue through due diligence, in the due diligence team, they found a news article that there was a report of a fire in that actual unit, that dwelling. And what had happened is it was, an attack, a fire attack. So somebody had, purposely attacked that retail shop. And so I was a bit like, I don't know what to do, but the risks are that it could happen again, but it's probably unlikely. And it happened through the Easter period in 2023, and we had been past that Easter period in 2024. So I was like, maybe it's not, maybe it's not going to be a thing anymore. So we continue with due diligence, and then throughout due diligence, we did a vendor, what they call the vendor, is a seller of the property, an interview, and we also do, a tenant interview. And so with that tenant interview and speaking to a bunch of other tenants in the block, they said, "Oh, it's been pretty quiet in the block since that fire," and that was not great news to hear. And then also, because that sort of stuff can not just wreck the shop for the tenants, but it can, for that whole vibe of the place, it can feel a little bit like, I guess the sentiment would be it's a little bit ghetto-ish. I don't know the correct word, but that's my terminology that I have in my head right now to explain that. And then so from there, I decided, okay, let's continue due diligence. It's likely not going to happen again. And then we found out from the tenant that they had received a text message that they were coming again. And we didn't know what that was. It was from an anonymous number. We've sensed that it was likely going to be another fire attack, and very grateful that the tenant shared that information with us. And yeah, we pulled out of the deal because of that.
Yeah, so I'd inject there because I looked at it as well and think there's no perfect property, say to people. There's a way to have a perfect portfolio, but the asset, take the lessee out of it, the asset itself, and the lessees, you should always keep that in the back of your head. Is you should never expect to hold the same lessee for your entire hold of that property. Trying to remove that was what it sounded like you were trying to have that more logical long-term thinking. So you kept pushing through, which was, wise, but it's just one of those things if there's one thing, there's two things, even Steve, when we had him on the podcast here, it was there's always something that's wrong with it, and that's okay. It's just when it keeps multiple things start showing up, then it's just pretty much well, yeah, what you did, it makes logical sense too. You can buy anything in Australia, between, you're within your budget range, which is a healthy budget. So, you don't have to go through with this. And that's obviously your decision at the end of the day.
Yeah, it's just how much risk is too much risk for you to take on. And yeah, it just ended up, even if I was to try and I thought about, with that tenant changing in, when the lease was up, or kicking him out, finding somebody different, it would have been great for the whole block. It would have boosted the value of the property as well. But just to get another tenant in, there's a few black marks against the name of the property because of the fire attacks. It's going to be hard for a tenant to really stomach that and warrant wanting to get into that property. So one fire attack, and then also a warning. I mean, it's likely linked to, after speaking to a bunch of more people about it, it's likely linked to some gang or some crime or something being in the tobacconist space. My dad had done a bunch of research through the news and found that was pretty regular in Melbourne, and these sorts of attacks on these different shops. So yeah, it was good to have him, analyze some news and come back to me with a conclusion that's pretty normal.
Who, just a part of the due diligence process, was it the buyer's agency that you're working with that found the article, or was it yourself?
Yes, the buyer's agents found that.
See, going back to that, that's really great. That's that extra mile, right? To not only do that, it's a quick little search, but from my perspective there's multiple quick little searches, and even if it's 5 minutes each search, you're doing 100 odd searches, it adds up pretty quick.
Yeah,
so, and I really love the vendor and the tenant interview. It sounds a little bit over the top for some people, but in this instance, this is why we do those things, right?
Yeah, absolutely critical. Yeah, so we bailed on that deal, and then I waited a while. I sort of recalibrated my acquisition criteria and decided I don't really want to go with retail too much. And yeah, then came through just recently a warehouse in North Brisbane. Great warehouse, great tenant. It had just been put on the market, and we just chucked it, put in an offer as soon as possible. Do you want to know what I liked and what I didn't like about the property before I move into
describe the asset, and let's riff on that.
So it was basically like an automotive tenant in a warehouse north of Brisbane. It was like 130 something square meters, and they had a good brand, the tenant or the lessor, and it was going to be, I was going to put a lot more cash in, and it was going to be quite positive, the deal, because of that. And I was like, this is going to be good, and I really enjoyed that, or liked that it was just a warehouse without too much maintenance, and also it was quite newish. I think it was like 2017 or something, and there was going to be some depreciation on that as well, which would have helped. Yeah, and it was just a more comfortable deal. I was able to put a lot more money into it, and so yeah, that's what I liked about it. And it was what they wanted. The terms were, they wanted to sell it really fast because they were trying to acquire another property, and they wanted it done as soon as possible. So we could see if we wanted to see if we could do 21 days finance. My broker's like, yes, we can do that. We came back, got confirmation we can do it, and we were about to get the contract written up for signing. There was myself and another party that were involved, and they were a similar price range. It was basically who could get the better terms faster and sign the contract. And then somebody came in and put in an offer that was significantly higher than both of ours. And my buyer's agent was like, look, it's not worth continuing at that price. It's not valuable at that price, which I thought was great to hear. It's a shame, but also great to hear that they weren't just trying to rush me into a property, even after all this time working with them and not having acquired one. So very unfortunate. I would have really liked to have gotten that deal, but it's just a part of it, Yeah, I try to not get too. What I try and not do is I try to not build an image in my head about what it's going to be like owning that property, and build a lifestyle based on what it's like to own that property, which is what I find a lot of my clients do when they're first acquiring an online business. Is they picture what their life's going to be like, and preempt that life, and that's dangerous, because then you are emotionally buying into something that you shouldn't yet do, because you don't know if it's going to work out or not.
Yeah, that's a really good point, actually. I haven't really thought about that. A couple of things I want to hit on, but let's tackle that point. So the psyche of the buyer, right? Like they're looking at, the income, like whether it's online businesses in your space or it's a commercial property, like they both have a passive income play that people are chasing. And I guess in your experience, is that what people they're buying these assets so then they can go, well, I've parked that cash and now I've got this income, so I can now justify spending a little bit more on my day to day? Or is it like, walk me through that?
I think it would probably be a little bit different with business. Most people are looking at acquiring a business that can replace their income. So they got in their head like, cool, I can quit my job on this date and I can do all these things and I'll make X amount of money per month from it. And what they do is they sell themselves into the business emotionally. What I had done in the past with properties is, and not at a crazy extent, but is look at the property and go, okay, I'll make X amount of money, or it'll be neutrally geared or positively geared. In one case, we bought one that was slightly negatively geared in my personal name, which turned out to be great. And I would then go away and calculate, and I've talked about this before on other podcasts with you, is that I'll calculate, all right, I've got X amount of debt in X amount of property, and what's my growth rate, and how will that compound over time? And I've built out like models and a strategy in my head of like when I can acquire another property with how much equity I could have from the growth of this one. And when you start going down that route, it's a bit you're buying into it emotionally to try and build a property portfolio faster, whereas everything hinges on like one little news article or one text message from somebody that could be, hey, there's a fire attack. So wait until you have the property before you start conservative projections. And yeah,
it's a good point. Taking the emotion out of it, and because that's actually a really good point. Where people go wrong is they do get emotionally invested, and this is also, we had a riff around this in the buyer's agent industry too, where it's people do get emotionally invested. It's very taxing. They're obviously paying a buyer's agent as a coach to sort of give them that like confidence. It's very easy for your buyer's agent to turn around and say, "Come on, Jaryd, just give me an extra 20 grand. We'll get it done," or 50 grand, whatever it was. Because then you're off the books. You still got an asset. It's a good asset. You just paid a little bit extra. But that's where, I guess, having that, established buyers agency that you're working with, where they know we know we can get a better asset because we're in the market every day, and at this rate, it's just not worth it. There is a fine line, like in that I deal with in the residential space, where some markets we're buying into are growing at 5% a quarter. So, you can get a little bit cute, and like I've pulled out a lot of deals, and then it's taken me 3 months to find another one. And in that time, it's seen that growth where it kind of ends up to be about the same. But I mean, I think you need to have the best interests of your client at heart as a primary, and people see through that stuff anyway. If someone's there pressuring you to buy, then that's where you should send us an email and let us look into it for you as well.
Yeah, definitely. Good points. Yeah, I mean, I like the point around the opportunity cost loss from waiting on the sidelines and missing out on a bunch of deals. At the same time, it's it's a tricky one. It's not this, like you said. It's really the balance, because you shouldn't be trying to go for that unicorn property. There's always like baggage involved with each one, and which is the right one based on the risk tolerance that you have, and how fast you want to get into the market.
Can I ask you a question, Jaryd? This podcast we're doing one-on-one. That's a silly question.
I like to ask you questions and me learn.
Nah, mate, we're all learn, do, teach, share, grow, all about it. So I just wanted the lease that was left on that tyre shop. How many years was left in it?
It had a 3-year lease. They had just signed, I think, at the beginning of the year, or it had about a 3-year lease left. Yeah, and it was a good lease. Yeah, I think it was 3% increases each year. I think it was 3 or 4%, just pretty standard.
Because that was it was basically it was a tire storage shop for a major tire business, right? And that had the shop front at the front of the complex, and yours was the large, or the it was good size. It had no mezzanine, but it was just that nice, clean concrete tilt, modern, lots of just easy sort of buying, or easy investing. So that was like a sublet to that business, right? Or did they was it all in one business? Because basically, I'll paint the big picture where if this business at the front that is the subletter of the property that you're buying into, they're selling that because they want to buy into a different residence. Does that mean that major show front at the front of that complex, is that going to then essentially buy something else and then move everything out in 3 years' time? Is there?
No. I think it was just the one tenant that was in that one warehouse.
Okay, cool.
Yeah.
You can pick it apart either way. I mean, that's going back to what I was saying earlier too, is you've got to expect your tenant to leave. It's just having that, all right, I've got a solidarity of 3 years of solid income coming through. The plan really should be, pay down that debt, because you're going to expect a 3. When this is what your buyer's agent will obviously tell you what the vacancy period is there, but I like to say 3 months, because you want to be able to wear that, because then it's just that short-term cash flow loss, but you're acquiring a tenant that could stay there for 10 years, so it's...
Yeah, and with that lease and that area, it was a very good area in the automotive space, and it was in pretty high demand in a great location. So it's, if the tenant was to leave, well, that'd be crazy to leave, but I'd probably get a better, tenant in.
Yeah, that's what I
Yeah.
was looking at too. I was like, the individual asset itself, I was like, it's highly desirable. We did the little street run up and down, and it was just, um, like strategically from a business perspective too. Like, where do you want to set up a business? And in that automotive space, there was just so many, neighboring properties that all sort of like linked in with each other. So it was a good asset, but yeah, I
Not meant
mean,
to be.
not meant to be. There's no point in overpaying for something, paying that emotional price, and then you're back onto the search. But was there any? I mean, the cons of that asset, like,
I mean, it was a smaller asset that I would probably want to acquire.
because you weren't using your full
Yeah, I
purchasing
wasn't using my
capacity.
full borrowing capacity, but I mean, it just made it more positive for me as well. And yeah, that's fine. Like, I would have preferred that. I would have preferred that asset than wait for a larger asset. And that's what I kind of looked at, is like, if I acquire this now versus like waiting another 6 months or something a little slightly larger, would I, from that growth rate of 6 months and holding this property, would I be in the similar position? Possibly. So
What was the yield on the property? 5.6 from memory, or that?
yeah, might have been a little bit more actually.
Yeah,
5.8 or something. Yeah.
it's very challenging to find things with a 6 in front of it. That's a legacy asset is what I call it, where you're going to have it for a very long time. But yeah, it's just, you just got to take it on its each and own merits as it comes through. I did like the asset myself, and I also liked that, from a risk perspective, you're not, like, you could acquire that asset really easily and you have a better cash flow position.
Mm-hmm.
So that's always good to have, especially for your first commercial too. You don't want it to be. That's sort of the misconception a lot, is that people are running around hunting cash flow, and you can get 80% loan to value ratios. You're not going to be positively cash flow at that stage for if you're towards that high end, because interest rates aren't 2% anymore. They're 7, and that's just a part of life. But over time, I was having this conversation with another client, and it's like, well, the hardest time in that property's journey, like, for you to hold, is at the start, because you're the highest leverage you'd be. And then with time comes rental increases, and then debt gets paid down. It becomes easier, and then that's that compounding effects too, where you now got that cash flow, which is just amplifying that pay down. Each couple of years, you see what you can do with it, and to make sure it fits within your risk tolerance to go again, or to just hold it.
Yeah, that coupled with, which are all great points, and also coupled with our current economic environment where interest rates are high, if they are to come lower, you just end up having a lot more, a lot more cash, or a lot more liquid then, because of the interest rate decreasing. And, then obviously, like you said, the compounding of you owning more of the property, so
Interest rates. That's a good little topic we can do for another day. Is economic climate, which I'd love to sort of. I'm getting, like, obviously, the older I get in my career, I start to look on a global scale now, and I even get to, like, because the world's becoming a smaller place. Like, we can invest in New Zealand, UK, Bali, if you want to do that. We're talking about one of those ones, but we're all more linked and intertwined. In Australia, like, I'll leave it on this point, is like, from a global perspective, Australia is a highly attractive nation to invest into, and that's why we're seeing a lot of your major, I guess, countries like your China, India, our migration trend from these really established countries. And when I say really established, they've, like, the Chinese dynasty's been around for hundreds of thousands of years, the Indians as well. So their population's quite strong, and they're looking for safety in investments, to where to park their money during these times. So that's why not only am I bullish on the Australian market for its current fundamentals, but looking forward, even talking with Luke, the data scientist, from Microburbs the other week. It sort of adds fuel to that fire where it's always going to feel like a nervous time, especially pulling that trigger to buy these assets. But the trend is in your favour. Like they say, the trend's your friend. So where interest rates go, going back to that one is, I do feel like we're at the peak interest rate cycle for now. But it could go up 25 basis points. More likely to go down next year. But you shouldn't be making a decision based on one or two interest rate rises here and there. You look at the long term.
Absolutely. Love that, Sam. I don't have anything else to add. I think that's a good wrap. Thanks for listening, everybody. Appreciate it if you want to chat.
If you have any questions too for, I guess, Jaryd in his commercial buying journey as a buyer, jump on the comments and put some questions in. We're getting a couple of really good listener questions, which is exciting. And happy to sort of share the journey with you. And thanks for checking on in.
See you on the next one.